Right now, at this exact moment, your money is quietly losing value. Silently, relentlessly, systematically. And most people don't even realize it. Let me give you a number that will completely change how you see gold and silver. If you had 100 in the year 2000 Rs, today that same 100 has the purchasing power of roughly $30.35 in real terms, depending on how you measure inflation. But here's the part almost nobody tells you measured against gold. That same 100 has lost over 85–90% of its value. Think about that. Not because gold went crazy, but because the dollar quietly got weaker year after year, crisis after crisis, stimulus after stimulus. And now, we're not in a slow decline anymore, we're in an acceleration phase. And that's exactly why what's happening in gold and silver right now matters more than at any point in the last decade. Because this isn't just another dip. This isn't just another correction. This looks very much like a major structural bottom forming in real time. Let's start with what you can actually see. Gold today is trading around the 4,600 to 4,800 range after recently pulling back from highs near 5,000 dirhams earlier in 2026. Silver surged all the way up toward 120 Fs per ounce at its peak before correcting sharply back into the 70 to 80 range where it's been consolidating. Now here's a mistake 95% of people make when they look at that chart. They see a big move up followed by a sharp drop, and they think the top is in. The bubble popped. The opportunity is over. But history says something very different. Because in every major precious metals bull cycle, this exact pattern shows up, not at the end, but in the middle. Welcome back to John Forecast, where we decode the macro forces behind the gold, silver, and global market moves. Let me take you back 2008. Silver collapses from around 21 down to $8 during the financial crisis. At the time, it looked like the market was dead. Confidence was gone. Investors were panicking, and yet within just 30 months, silver didn't just recover, it exploded to 49 per ounce. That's a 500% plus move. And the people who bought during the fear phase, they weren't lucky. They understood the cycle. Now fast forward to today. Silver runs from roughly 34 in early 25 to over 120 in early 2026. That's more than a 3x move in under a year. Then comes a correction, a sharp one, driven largely by CME margin hikes, forced liquidations, and leveraged traders getting wiped out. Sound familiar? It should. Because this is exactly what happens in every strong bull market. Leverage builds up. The market overheats, then the system resets itself. Weak hands exit, strong hands accumulate, and the next leg begins. But here's where this cycle becomes different and potentially much bigger. Because this time, it's not just about investment demand, it's about structural demand. Let's talk about silver for a second. Silver is no longer just a monetary metal. It's an industrial necessity. Every solar panel requires silver. Every electric vehicle uses silver. Every AI data center, every circuit, every high-efficiency electrical system needs silver. And according to data from the Silver Institute, global silver demand has crossed 1.2 billion ounces annually. But supply, roughly 1.0 to 1.05 billion ounces, that's a massive deficit, year after year. And here's the key insight most people miss: deficits in commodities don't disappear. They accumulate. And eventually, they resolve through price. Now layer on top of that the macro environment. The Federal Reserve is trapped. Inflation is still sticky. Economic growth is slowing, debt levels are exploding, and the US government is running deficits that are getting harder to finance. So what happens next? There are only two paths. Either the Fed keeps rates high and risks breaking the economy, or they pivot, cut rates, and flood the system with liquidity again. And here's the part that matters: gold and silver benefit in both scenarios. Higher rates stress the system, safe haven demand rises. Lower rates weaken the dollar, metals rise. There's no clean escape. Now let's talk about something even more important. Who is actually buying? Because price alone doesn't tell the full story, positioning does. And right now, we're seeing one of the most bullish divergences in years. Paper market participation, especially future speculation, has dropped significantly. Open interest in gold has declined from highs. Speculators are stepping back, but price holding strong, even rising. That tells you something critical. This isn't leverage driving the market. This is real demand, physical demand, central banks, sovereign buyers, long-term allocators. And central banks are not guessing. They're acting. For the past several years, central banks globally have been net buyers of gold at record levels. Countries are reducing reliance on the dollar, diversifying reserves, moving into hard assets. Why? Because they watched what happened in 2022. When reserves can be frozen, when currencies can be weaponized, trust changes. And once trust changes, capital flows change, permanently. Now bring this back to the present moment. Gold pulls back from highs, silver corrects sharply, speculators exit, sentiment cools, and the mainstream narrative becomes, it's over, but under the surface. The structure is getting stronger, not weaker. This is what a bottoming process actually looks like in a bull market, not a V-shaped bounce, not instant upside, but a reset phase where conviction gets tested, where weak hands leave, where strong hands quietly build positions. Let me give you one more data point that should make you pause: the gold-silver ratio. Right now it's sitting around 60-65. Historically, the long-term average is closer to 50. And in strong bull markets, it compresses even further into the 40 range or lower. Now do the math. If gold is trading around $4,800 and the ratio moves back to 50, that implies silver around 96. If it compresses to 40, that's 120 per silver. And we've already seen that level once, which tells you something important. The market has already tested that pricing zone. This isn't speculation, it's structure. Now here's the real question. Why are most people missing this? Why is 95% of the market still on the sidelines? It comes down to psychology. After a correction, people hesitate. They wait for confirmation. They want certainty. But markets don't reward certainty. They reward positioning. And by the time everything feels safe, the move is already underway. Think about the average investor right now. They're watching stock market volatility, interest rate headlines, geopolitical tensions. They hear about gold hitting highs, then pulling back. And they assume, I'll wait. I'll see what happens. I'll get in later. But later is exactly when price moves, not before. And this is where things get interesting, because we are approaching a point where multiple forces are aligning at the same time: structural supply deficits in silver, central bank accumulation of gold, weakening confidence in fiat currencies, rising geopolitical instability, potential Fed policy pivot. When these forces converge, moves don't happen gradually, they accelerate. So what does this mean right now? It means this current phase, this pullback, this hesitation in the market may not be weakness. It may be the final consolidation before the next leg higher. Not guaranteed, but historically consistent. If you've made it this far, you're already ahead of most people watching the markets today. But the real question is, will you recognize the move when it starts? Or will you only believe it after it's already gone? If this breakdown is giving you a clearer picture of what's really happening in gold and silver right now, make sure you subscribe and turn on notifications, because perfect, now we move into the part that really separates surface level analysis from what actually drives markets. Now let's go deeper. The real move in gold and silver. It doesn't come from retail investors. It doesn't come from headlines. It comes from institutional capital shifting direction. And right now that shift is already happening quietly. Let's start with something most people never look at. Not price, not charts, flows. Because price is what you see. Flows are what actually move the market. And right now, institutional behavior is sending a very clear signal. While retail investors have been hesitant, while most people are waiting for confirmation, large-scale capital is doing the opposite. They're accumulating into weakness, not chasing strength, buying dips, positioning early. Look at what's been happening in the broader financial system. Money market funds in the US alone are holding over $6 trillion in cash equivalents. That's not normal. That's not confidence. That's hesitation. That's capital sitting on the sidelines waiting. Now think about what happens when even a fraction of that money decides to move. It doesn't need all $6 trillion. Even 5% rotation is $300 billion. The gold and silver markets are not built to absorb that kind of demand smoothly. So what happens? Prices don't rise gradually. They reprice violently. Now let's talk about central banks, because this is where the signal becomes impossible to ignore. Over the past few years, central banks have been buying gold at one of the fastest paces in modern history. Not occasionally, consistently, strategically, and importantly, they are not buying at the top. They are buying during consolidation phases. Exactly like the one we're seeing right now. This is not random. This is not emotional. This is policy-level decision-making. Countries are reducing exposure to the US dollar, diversifying reserves, preparing for a world where currency stability is no longer guaranteed, and gold is the neutral asset in that system. Now bring silver into the picture, because silver follows gold, but with a delay. And when it catches up, it doesn't move slowly. It moves fast. Here's what institutional research has been pointing to. Major banks like JP Morgan Chase, Bank of America, and Citigroup have all released outlooks on silver. And while their exact numbers differ, the direction is the same, higher, across the board. Some estimates put silver's base case in the 80-90 range, bull cases, well above 100 LUPs. And those projections are not based on hype. They're based on three core drivers: gold-silver ratio compression, structural supply deficits, industrial demand acceleration. All three of those are active right now. But here's where things get even more interesting, because there's a disconnect, a massive one, between institutional positioning and retail perception. Retail investors are still thinking, did I miss it? Is it too late? Was that the top? Meanwhile, institutions are thinking, this is the reset. This is where risk-reward improves. This is where we scale in. That gap, that difference in perspective, that's where opportunity exists. Now let's bring in the Federal Reserve, because this is where the real trigger begins to form. The Fed right now is in a position with no clean outcome. Inflation is still above target, growth is slowing, debt is expanding, and financial conditions are tightening. If the Fed keeps rates high, they risk breaking parts of the economy. We're already seeing stress in commercial real estate, regional banking systems, consumer credit. If something cracks, liquidity comes back. Fast. If the Fed cuts rates, The dollar weakens, real yields drop, and gold and silver respond immediately. This is what we call a policy trap, and historically, precious metals perform best inside these environments. Because uncertainty increases, confidence decreases, and capital looks for stability. Now here's the part almost nobody is talking about clearly, the timing mechanism. Because markets don't move just because fundamentals are strong. They move when something forces repositioning. So what could that trigger be? Let's walk through realistic scenarios. Trigger 1, a Fed pivot the moment the Fed signals rate cuts. Not speculation, not rumors. An actual shift in policy tone. Markets will react instantly. Gold moves first. Silver follows and accelerates. Trigger 2, financial system stress. If a major bank, fund, or sector shows instability, liquidity floods in. Confidence drops, safe haven demand rises. We've seen this before. And when it happens fast. Trigger 3, dollar breakdown. If the US dollar weakens aggressively, gold doesn't wait, it reprices. And silver, because of its smaller market size, moves even faster. Trigger 4, supply shock in silver. This one is less talked about, but incredibly important. If industrial demand continues rising and physical supply tightens further, you don't get a smooth price increase. You get availability issues. Premiums rise, inventory shrinks, and price jumps to find equilibrium. Now here's where everything connects. We don't need all 4 triggers. We only need one. Because once the move starts, momentum builds, and then the second and third effects follow. Let me explain that clearly. Gold starts moving, attention increases, key capital flows, and B price accelerates, key media coverage expands, media expands, retail enters, and then the late stage begins. But right now, we're not there yet. We're still in the early to mid-phased, the phase where sentiment is mixed. Price is consolidating. Most people are uncertain, and historically, this is where the best positioning happens. Now let's go back to silver for a moment, because this is where things can get explosive. Silver is a much smaller market than gold. That means 2 things: it's more volatile. It moves faster when capital flows in. We've already seen silver go from 30 to 120, going 7 to plus. That kind of volatility scares people. But for institutions, that volatility is opportunity. Because when silver breaks, it doesn't move 10%. It moves 50%, 100%, sometimes more in very short time frames. And that's not theory, that's history. Now combine that with today's environment structural deficits, rising industrial demand, monetary instability, institutional accumulation, and you get a setup that is extremely rare. This is not about predicting exact prices. This is about understanding positioning, understanding structure, understanding timing. And right now, the structure suggests something very important. This consolidation phase may not be weakness. It may be preparation. Preparation for the next move higher. Preparation for capital rotation. Preparation for a shift in perception. Because markets don't move when everyone agrees. They move when most people are still unsure. So let's bring this together. Here's what we know: institutional capital is positioning quietly. Central banks are accumulating consistently. The Fed is trapped in a policy dilemma. Silver supply deficits are real and growing. Retail investors are still largely on the sidelines. That combination doesn't happen often. And when it does, it usually leads to asymmetric outcomes, where the upside potential outweighs the downside risk from a structural perspective. Markets are not about certainty, they're about probabilities. And the highest probability opportunities rarely feel comfortable. Right now, gold and silver don't feel safe. They don't feel like a guaranteed win. And that's exactly why the opportunity still exists. Because by the time it feels obvious, the move is already gone. Gold day 700 to 800 range, silver 72, 75 range. After gold peak near 600 plus, silver spike above 120. That pullback, that volatility, that confusion, that's not weakness, that's structure. That's the market resetting positioning, shaking out leverage, removing weak hands. Before the next leg, the conditions that create major upside moves are already in place: negative real rates, structural supply deficits, institutional positioning shift, dollar weakness, industrial demand surge, geopolitical instability. All that's missing? The trigger. And triggers don't give warnings, they just happen. What this means, now let's be very clear about something. This is not about timing the exact bottom, predicting exact price targets, making guarantees. Markets don't work that way. But what you can understand is structure, positioning, probability. And right now, the probability structure is shifting, not because of one event, but because multiple forces are aligning at the same time. The 2 types of investors at this stage in every cycle, you always see 2 groups. The first group waits. They want confirmation. They want certainty. They want the move to already be obvious. The second group prepares. They study the structure. They understand the risk. They position gradually. And historically, the second group benefits from the transition. The first group reacts to it. This isn't about chasing a price. It's about recognizing a phase where the system is under pressure. The policies are constrained. The flows are shifting. The narratives are breaking. And in those phases, real assets tend to reprice. Gold leads. Silver follows. And when silver moves, it moves fast. If you're getting value from this breakdown, this is exactly the kind of analysis this channel focuses on. Real data, real structure, no hype. Consider subscribing so you don't miss the next piece, because the next phase of this story is where things start to move quickly. Most people don't miss opportunities because they didn't hear about them. They miss them because they didn't recognize them early enough. Right now, the signals are there, not in headlines, not in hype, but in structure. Gold holding strength after a major run, silver resetting after extreme volatility, institutions slowly shifting, macro conditions tightening, and whether this becomes a major move over the next 6 months or the next 18 months, the setup is already in motion. But one thing is clear, this is not a normal environment, and normal expectations won't work in abnormal conditions. If this breakdown gave you a clearer perspective, drop a comment with one thing that changed how you see gold or silver right now. And if you know someone watching these markets but unsure what's happening, share this with them. Because by the time it's obvious, it's usually too late to be early.